What is going on, you guys? Happy Sunday. Just ended up getting back from my recent adventures over at the in-laws, so I apologize for being about 30 minutes late to this one. I had to make sure that I was basically providing myself enough time to be able to prepare something for all you guys to talk on. I think that there's a lot of really important stuff that's been going on this week, especially in the headline aspect. Like this is definitely a headline market. What I've really noticed here is that, like, gosh, man, it seems like as we head on into this week and we had a lot of Israeli and Iranian conflict, and it's just like the timing is almost impeccable. I don't know if you guys have ever noticed this, but after the past couple of years of investing in the stock market, anytime the stock market ends up falling, there's always negative headlines. And I'm not doubting that this stuff is going on. I just think that during periods of time when the market is falling, negative headlines come more to fruition. Where, on the other side of things, it's not like the war in Ukraine wasn't happening. It's not like Israel wasn't in a war over there in Gaza. Like when the stock market was going up during this AI euphoria, but that's all that we end up seeing is that we see AI this, AI that, Nvidia this, Nvidia, Tesla, robotaxi, and all this other stuff. It's just kind of like the timing is definitely impeccable. Where I don't know if it's the market cycle that determines the headlines, or if the headlines determine the market cycle. Anyway, I have to go on just a mini rant here too. And this is just something that I've really noticed over the past couple of years. And it's just mind-boggling that people never really fully like understand or even like remember like what's going on. I'm not saying all you guys. I'm just saying like these a lot of influencers and a lot of other people on that are basically trying to post for a lot of engagement and whatever they might. I don't know exactly what they're doing, but it seems like that whatever's the hot topic of that day, they almost exacerbate it. So that whenever the market's down, there may be a lot of negative posts and a lot of like we're gonna die. I think on YouTube I actually made a post saying the world is falling apart, and it's like that was the biggest clickbait thing I've ever done before in my life because it's not falling apart at all. So what I wanted to do today is actually provide a lot of rational thought behind what's going on in the markets and really put the correct context as to why the markets are selling off. Because I even said this last week that I thought the markets were going to sell off. Everything, the technical setup was there, the inflation reading was there. I mean, at some point, like we can't always just go straight up and to the right. And you should always expect that there's going to be stock market volatility, and always expect that those moments, those opportunities, they will come. So like I think that was one thing that I ended up realizing back in 2020, 2021 timeframe, was that when we saw all those stocks go up and to the right for about a solid, let's say 6, 9, 12, almost in some cases 2 years, about a year and a half, we ended up seeing a ton of stocks just go up and to the right. And every single one of these stocks, people were just like fumbling over themselves. And Tesla was one of them, fumbling over themselves to make sure that they bought it, right? And they just couldn't pay, like there was no price that was too high for these people to pay for these stocks. And then you just see like it's just X is one of the best sentiment fades in the history of fades because everyone talks about the same thing, and then as soon as everyone talks about the same thing, it's almost like boom on a dime. It's like that's where you find the turns is basically with the headlines that you end up seeing on X. And the funniest thing is that a lot of the same people do it like every single cycle, every single turn. Like when things get really bad, certain people get very pessimistic, feel down, very emotional about it, and they don't necessarily understand that there's an opportunity there to take advantage of. And then on the other side of things, when a lot of people are very euphoric and excited and they're fumbling over themselves to buy the newest, latest, greatest, hottest stock, um, it's the same thing. And then all of a sudden things turn, and then the emotional cycle resets. So I think that what I really try to do here on X, and the whole reason why I'm even like still creating content, is that I do think that there's definitely a need for some rationality, and basically tying things directly to what the stock market is, and that is earnings, right? Corporate earnings. Like this is essentially what dictates how stocks trade. Sometimes they're trading above their intrinsic value. Sometimes they're trading below their intrinsic value. Sometimes some sectors outperform others, and sometimes other sectors outperform others. It's the way that Wall Street works. They're always trying to catch like the next trade, right? But sometimes, like you have an option to be able to continue to play that game with Wall Street if you'd like to, and that's like the trade, like what's going on this next quarter, what's the macro picture, which earnings are going to outperform what earnings, whatever it might end up being. Place your chips where they may. But then there's the other side of it. This is the side that I've learned to really focus on is not necessarily focus on the next 3 to 6 months, but really focus on the next 12 to 2, 3 years and try to position my portfolio to, forego maybe 3 months of performance, whatever it might end up being, because Wall Street's going to do what they're going to do. They're going to sell when they want to sell, and they're going to kill a sector when they want to kill a sector. And there could be really no rhyme or reason for this. And there could be something that's completely irrelevant to the corporate earnings. So, like, for example, like a lot of tech stocks right now, and a lot of people haven't been paying attention to this because the S&P 500 has been going up, the NASDAQ has been going up. But a lot of high beta stocks and long duration is what they call it. So long duration stocks have been getting absolutely killed this year. They're down collectively at about a 5 or 6% right now. But this has a lot to do with the inflation picture. So with inflation resurgence, and then also the rising 10-year and 2-year. So that's a perfect storm for duration stocks to actually get sold off. And a lot of people don't necessarily think to themselves like, oh man, like, could there actually be a different rationale for why these stocks could be selling off? Or is it actually the business that's selling off? And in many cases, sometimes in that short of a time frame, 3 to 6 months, corporate or a company's earnings and a company's picture, like thesis, the total picture of the company, it doesn't change that quick. Usually it starts changing over the course of 1 to 2 to 5 to 10 years. And that's really how those cycles end up working. So I do have some things prepared here for you guys. I want to make sure that I'm talking a lot on, obviously I got dry mouth because I'm always talking, right? I don't usually talk as much as I do in these lives, but I got a lot of things to talk about for you guys. Last week we had inflation come out, and if you guys were there last Sunday, I ended up talking about how I thought that the markets were destined to sell off if inflation came off hotter than expected. Not only just from like the inflation catalyst alone. I think that the catalyst was the inflation, but when we looked at how the sectors were rotating, remember how we saw. So just recapping last week, because what I like to do is I like to make sure I'm telling a story to really portray how I visualize the markets, because it's not something new every single week. It's an ongoing thing, right? The market cycle is an ongoing picture. It's ongoing. It's always evolving into something new, and there's like a different stage in the cycle. And the cycle is predictable because you can look at the past 100 years of stock market data, and you can get a better picture of like, hey, this is probably the time stocks should start selling off, or hey, this is probably the time stocks are going to start bottoming. So from last week, what I ended up talking about is we looked at the S&P 500, the technical picture there, as well as the NASDAQ, and we saw that the major sectors that were performing really well was going to be XLE, XLF, XLI, and we saw gold rallying. And a lot of these are going to be risk-off sectors, defensive sectors. And we also saw consumer staples perform really well on a year-to-date basis. So a lot of the other sectors that historically perform really well and major market tops were performing really well. So that's our intermarket analysis picture. And then you even take a look at the gold chart, where it's like now it's breaking out, and it's a lot of people are asking themselves on Twitter, like, or X, whatever you want to call it. And they're asking themselves, like, what does gold know that we don't necessarily know or that we're not following along with? Once again, going back to intramarket analysis and understanding how the other markets are moving to get a better picture of like what we think the stock market's going to do, or the certain sectors that should perform and how they're going to do. But that's what I ended up talking about last week. And we also looked at the technical picture. We'll do another update here. Talk about how we're starting to see that MACD curl over. And what it's really looking like is it actually looks like that the markets are going to sell off, but I'm not sure if it's going to be 10% down like I thought before. I think it's going to be a lot more about like a 6 to 8% down. This could happen over the course of, it could happen next week. I've seen markets sell off 10% in a week, or it could happen over the next 2, 3, 4 weeks, or it could happen over the next couple of months. We don't 100% know. We could see a lot of consolidation here, but I do think that I have some good perspective as far as like from a technical picture, good perspective on like where I think that we can really go. Then we'll make sure that we touch up on inflation and talk about how inflation impacts the macroeconomic picture and how this impacts not only just the macroeconomic picture, but like how the treasury yields are moving. Because this is the most interesting part to me is how we're seeing the 10-year yield, what looks like really going on. It looks like it actually wants to touch higher. It's higher highs if you look at the yield, but it's actually a lower low on the bond prices. So bonds are unusual in the sense where the higher the yields go, that's the lower the price of the bond. So it's kind of weird how it works out like that. I'll explain that on a different video one day. But it's very unusual to see that they've been rallying. So the yields have been going up. So bonds have been selling up, but yields have been rallying. And seeing the yields go up this quickly, especially on inflation data, and then when you actually take a look at the Fed expectations, the rate expectations, this was one of the most interesting parts of last week's data, is that we went from pricing in about 4 or 6 rate cuts this year to there's even some rate hikes on the table. So we'll make sure that we take a look at that, and then also we'll get a better picture moving forward. And we have to talk about earnings season and the importance of earnings season moving forward. This is something that I think is absolutely going to be a major market mover. I think corporate earnings are going to be, they're the whole reason why the market ended up going up in 2023. And when a lot of people were just like, oh, inflation's still high, we're going into a recession, inverted yield curve, whatever might, but corporate earnings still looked really strong in 2023. And then there was a lot of great visualization about like what the macro picture looked like and how the economy looked. If you followed corporate earnings, you'd notice that they were beating and raising expectations in 2023. Now we're heading into a new earnings cycle. And now we actually have about 4 months of data that a lot of CEOs in 4 months, by what I'm talking about is January, February, March, April, right? So now they have four months. And then once we go into May, because this usually goes from about mid-April to mid-May, it's like the dominant earnings season. Now we're going to be about 4 to 5 months into this year, and we're going to have a really good understanding of like what's going on in the economy on a holistic basis. So I think that this is going to be really important to pay attention to. I think that things are relatively optimistic out there, but there's definitely some shakiness in the market. So without further ado, let's get into the meat and potatoes here, guys. All right. So last week we ended up having inflation data come out. I think Nick Timmerose always, I love this squiggly chart right here, just because it tells me like what the short-term trends and the long-term trends are doing. So when you actually see that 3 month start reaccelerating to the upside and the 6 months reaccelerating, but even though it's like on a year-over-year basis, it looks like it's still okay. But that 3 to 6 month reacceleration is actually really concerning. And I do think that that has a lot to do with a lot of the easing in financial conditions that have occurred over the past couple months, let's say, since 2020, since like the bottom in October. So if you guys can recall, this is just a few months ago, like 5 or 6 months ago, if you guys can recall, at the bottom of the October correction, we saw that, financial conditions were tightening, the 10-year yield was rising, so yields were going up, stocks were going down, financial conditions were tightening. At the bottom of that, that's basically the moment that the 10-year yield peaked out, that we actually ended up seeing the bottoming in the stock market, and then it's just been straight up and to the right since that time frame. That time frame to now, so like from that bottom to now, I mean, we've seen nothing but periods of euphoria, especially when it comes down to AI infrastructure stocks. And then we even saw like a lot of software names start to get extended to the upside as well. So a lot of tech names really got extended, and even the S&P 500, especially the large cap index. I mean, I got to show you guys this. So we'll just jump to this here. We can even see that even like the Mag 7 here, like the valuations is expanded to now nearer 2021 levels, when we were in some sort of a stock market bubble. And then you can even see like the S&P 500 on a broad basis. Now it's trading at about a forward PE of 21. This doesn't seem super rational to me. And the reason why it doesn't seem super rational is that, number one, the yield curve is still uninverted, or it is still inverted, excuse me. The yield curve is still inverted. Inflation is reaccelerating. And the Fed is likely going to start becoming more hawkish now. This is a perfect recipe for large cap stocks to actually start selling off. But when you see a lot of these small and mid caps companies, I mean, the valuation looks more than reasonable right now, where it's just like, yeah, if they fall, it might be about another 10% or so. And then you can even see like a lot of the software names that I follow is that, this is basically within historical norms. This is just a Jam and Ball's latest, their latest, I guess Substack is, yeah, their latest Substack, where you can actually see that the high growth portion, like the high growth median, is down to about 9.4. This is down from where it was to start the year. So this is like February to start the year, when everything was pushing like that 15 to 20x next 12 months EV to sales. A lot of those companies ended up selling off, and they are reasonable prices right now. And keep in mind that a lot of these companies are even free cash flow positive, but still, once again, tells us that things are relatively normal. They're stable here. So I think that is something that's like, when you look at how the sectors are behaving right now, where it's like you see a lot of the large cap stocks still trading at really high valuations. You see the rest of the market trading relatively reasonable, and even a lot of the value names are still trading relatively reasonable. So that tells me if the market sells off, of course everything is going to go down. But that tells me that usually when you start seeing that snapback rallies, like that V-shaped recovery, that V-shaped recovery occurs when you take fairly priced stocks and you push them down to lower valuations, and then whatever the catalyst was for the correction, when that ends, then that's when you see that snapback V-shaped rally. And I think that that's what's going to happen with a lot of these companies, where all of a sudden you're going to see them absolutely rip, and in some cases go up, 30, 40, 50%. Um, but I didn't think that inflation really impacted the markets as much as I thought that it would last week. And that has a lot to do with how the PCE data came out. So PPI came in and saved the day. So this is once again Nick Timmeros. So you can actually see that the PCE, so like when you take CPI and PPI, and this is a huge reason why PCE is usually like a non-catalyst, even though the Fed pays attention to that, because a lot of these economists, what they can do is they can get a really good picture of what PCE is going to be when they look at the CPI and PPI numbers. So the PCE, this actually went down, so down to 2.7 from 2.8, and it's showing that it's not accelerating too much to the upside. Obviously, it's still hotter than the Fed would like. And when the Fed talks about 2% inflation, they talk about 2% PCE, not CPI. So when I ended up talking about like how this impacted the rates, I wanted to really show you guys this. This is really interesting to me, because remember, we were supposed to get a rate cut going into this year in March or May meeting. We got a pause last meeting in March. So in May 24th, this one coming up, right now there's about 94.1% odds of just an outright pause. Now you can actually see, and this is what was really interesting to me, is that just a couple months ago, actually I think about a month ago, so we can come down here. So we can see that there was 0% odds one day ago. And you can see that like right here at that one day on the 12th of April, 0% odds. And it's been at 0% odds that there would even be thought of a rate hike all year until now, until Friday's data, when that came out. That to me is probably the most significant. And you can actually see that even in June too, that the rate odds, or the odds of a rate hike, are still there at about 3.9%. And then now we've effectively completely scrapped June. So we like right now the markets are saying like June rate cut is out of the picture. And then going to July, the odds there right there are still a rate cut. But at the moment, like it's when I looked at this, I noticed that it was about that September, November meeting, when they're actually thinking, actually, this looks like it's a rate hike. Yeah, so September has odds for a rate hike at about 40.9%, because right now we're here, 5.25 and 5.5. So that's really interesting. Okay, I didn't see that. But once again, I did see towards the end of the year that we were having, that is crazy, man. Okay, I actually didn't see that. So we can actually take a look at that down here, about 5 point. Yeah, yeah, we can see that the odds of a rate hike have actually went up pretty much all throughout the year. So the way that we can look at this is that we can think, hey, they probably actually just pushed out a rate cut for this year almost in its entirety. So that's really interesting. That's probably why a lot of the tech stocks have been selling off, honestly, and a lot of the higher beta stocks, is because I didn't actually see that before when I was preparing this. Anyway, when we actually take a look at the yield curve here, it's been really interesting. So like when we take a look at the 2-year yield, that's been relatively stable. So like what we've actually been experiencing is what we call a bear steepening. So the 2-year yield is relatively unchanged, but back to that October low. But when you actually come over here and you take a look at the 10-year yield, and I'm going to see if I can't come out a little bit. The 10-year yield has been coming up pretty much all year this year. So you can see that like this black line right here is the year mark. All year this year, the 10-year yield has been going up, and we actually see that upward sloping on the MACD there. So that tells us that we're in a short-term uptrend. Right now, when we take a look at the inverted yield curve, that bear steepening that I'm talking about. So when a bear steepening occurs, that's when the long end of the yield curve is going up and the short end of the yield curve is basically staying the same. So the short end, think about that as like two-year treasury bill and below. Then the long end is like 10-year treasury bill and above. So we're still seeing that on inverting of the yield curve that we've been seeing for the better part of a year now, but it's been a lot more on the long end of the yield curve. Now, the reason why this is important is that that tells us actually, so when we see the long end of the yield curve go up, this puts a lot more pressure on the economy. I talked about this last week, but I just got to make sure that I'm repeating this just a little bit, just to make sure that I'm refreshing people's minds. When the long end of the yield curve goes up, this is what actually impacts the economy. So the short end of the yield curve, it does impact the economy moderately, but the long end of the yield curve, what this actually does is that this is what real estate prices or the real estate interest rates are directly correlated to. So it does affect the real estate market, which is, I don't know, I think it's about 30 or 40% of our total GDP. This also impacts the vehicle market. So you could see a lot of weakness in Tesla or anything that's connected to the vehicle market. So a lot of some of the semiconductor names or like a lot of the solar names could be impacted just because of interest rates. So, and this is usually correlated with the long end of the yield curve rather than the short end of the yield curve. So when you see that bear steepening, this is like putting downward pressure on the economy, not just markets. So that's definitely something that I always make sure that I'm paying attention to. And you can actually see this being reflected in markets. I got to make sure that I'm sharing my screen here. You can see the NASDAQ, and this is actually a really bearish pattern. So I made sure to add in black lines of where I think that the NASDAQ could fall back to. So we can see that it's actually approached a resistance line, which was the recent high made in 2021. So you can see that it's been kind of stalling out here, but not only that, but we're actually seeing the MACD curl over and the RSI starting to show some weakness too off of overbought conditions. It would not surprise me in the least bit to see the markets do something like, I don't know, something probably like go down, maybe a small rally upwards, like an ABC down. And then we could see like it even come back into like maybe this area. And that's not that much of a correction. And I don't think it's actually, this time frame is not right, but this pattern is what I could actually see the stock market doing over the next couple, let's say couple weeks, probably over this next quarter, is I could actually see the stock market experience quite a bit of weakness and come back into that 200-day moving average at the very least. And when we actually look at how that 200-day moving average is moving, so we can see kind of like gauge it out. So it could do something like a 1, 2, 3, come back into the 200-day moving average, and then resume its uptrend higher. That would make a lot of sense, especially as I think that inflation is going to start to get back under control because the markets should start selling off here. So that's going to tighten financial conditions. And then not only that, I do think that the yield curve, the 10-year yield curve, is going to continue to go up because of the recent inflation data, which should further tighten financial conditions. And I do think that that's going to put a downward pressure on a lot of the inflation readings that we've been getting recently. So I don't exactly know how far. It's like, that's why I don't usually sell my stocks when I think that the markets are going to go down. It's usually, I make like a general assumption saying, yep, stock market's going to go down. But you can see here that I'm like, okay, is it going to be the 200-day moving average? Is it going to be this recent structural low or this recent structural high? So like the previous breakout, could it go down to here, which is like the low made in October / the recent high in August? So like that's kind of a structural support line, or maybe even the 200-week moving average. So I'm not 100% sure. I don't think that this is going to be a crash. I think it's a lot more likely it's going to be a correction. And the S&P 500 is actually showing a pretty similar situation here. So you guys can actually see this is a lot more clear of a picture. And you can, so like from a structural perspective, this makes a lot of sense to see the S&P 500 come down into this area. So like even when we take the 200-day moving average and put like its recent trend and like get an idea where it is. And then not only that, but it could easily come back and retest its previous breakout. That would make a lot of sense. And that's really not that big of a move. It's only a 300-point move. So like, this is just rough math here. So you take 5,123, what's 300-point move off of that? That's going to be roughly like a 6% move down. So like that's maybe 5, 6, 7, 8, somewhere in there, high single digits. So I think that that's really not that too much of a move. It's not something that you should sweat. This is probably something that's a lot more healthy, if anything, and should set us up really nice for the rest of the year to resume our uptrend. That's what I'm thinking here. And that's even in the face of a lot of the large caps, like the forward PE that I was talking about before. Because here's the truth, like even though in a perfect world, I wish that like my tech stocks like would always go up and outperform the S&P 500. It's like, no, it's not always going to be like that. There's a lot of circumstances here where the markets move together, and sometimes certain markets move faster than others, and then certain markets move more aggressively to the downside and the upside at certain points in time. But generally, the moves are about the same. So I think that the S&P 500 could definitely fall back into that range that we were talking about there, where it's um, and like I said, it's like a 6 or 7% move down to 4,800. This would set us up really, really nice, guys. And I think that I'd be really optimistic if that actually ended up happening. And that would be a buyable low from my perspective, because it should actually re-meet that 200-day moving average, cool off a lot of the froth. We could see the recent outperformers in the beginning part of this year really start to struggle for a full year-to-date performance. So like from here, and I've been talking about this probably for the past 3 weeks. So a lot of the major performers like NVIDIA, Meta could potentially be one of them too. A lot of these performers that have really crushed it year to date, I could see them actually start underperforming for the rest of the year, just because a lot of higher expectations have been baked into these stocks. And I can see a lot of the laggards actually start to outperform. That's in assuming that if the 10-year yield actually starts topping out at some point over the next couple of weeks, then we could actually start seeing a lot of the cyclically sensitive interest rate stocks like Tesla or a lot of the solar names actually start to perform relatively well for the rest of the year. And then from a Tesla perspective, obviously a lot is riding on autonomy. So I do think that we need to talk about like what's going on in like looking forward. This is we actually got a lot of stuff going on. So taking a look at the week ahead, obviously we had inflation last week, and we talked a little bit about that and how that actually. So I think it's been four out of the past four inflation readings, 3 or 4 inflation readings, they've actually all came out hotter than expected. This has put a lot of pressure on the markets. So looking forward, we're going to make sure, like right here is what I wanted to actually show you guys, that on Tuesday, Jerome Powell is going to talk. And this is really significant. And the reason why this is so important is that this is like the third or the fourth inflation reading in a row that we've seen like hotter than expected numbers. So I want to know, I think that the market wants to know, what is Jerome Powell thinking about with rates? And more important, there was a lot of headlines that came out last week, if you guys can remember, where Joe Biden came out and said, we will have a rate cut this year. Now, this is dangerous because the Fed is supposed to be independent by law from the federal government. And the Fed is not supposed to get involved in a lot of the presidential election cycles. But it seems like every single year, whatever president it might end up being, and this actually happened in the 1970s. So here's a cool history lesson for you guys. So the reason why this ended up happening, so if you guys know the 1970s inflation era, and a big reason why that ended up happening is that was the political pressure being placed on the Fed. So in the late 1960s, there's the guns and butter program. This is essentially an economic philosophy where the United States government it's like basically like the guns and butter programs that came out. So there's a lot of new social programs, and then also the Vietnam era or the Vietnam War was going on at about the same time when this ended up happening, and coupled with the demographic boom from the baby boomers. So you can actually see the demographic boom, and a lot of these young adults at that period of time were the baby boomers coming into their prime home buying years. So you saw a massive expansion of credit, largely driven it was largely driven by obviously the government and a lot of the government programs that ended up coming out, but more importantly, also the demographic boom that we ended up having. So a lot of people were taking out more money, thus creating money to go buy cars, to buy houses. And then we had the oil embargo and inflation shock of the 1970s. But the reason why the 1970s inflation stayed around so long is because there was interference with the federal government, talking about like the federal government came out and they said, we got to make sure that we can cut rates. So like every single time the economy started showing a moderate amount of weakness, they would cut rates they cut rates right away. And what this essentially did is that this kind of like kept on releasing the inflation genie out of the bottle, when to make sure that the inflation genie goes away, you needed to come into what Paul Volcker, he was the one that created the new philosophy or the new policy. He basically came in and said that the inflation was not necessarily going to be a result of just money creation. Once inflation is let out of the genie bottle, then one of the biggest drivers of inflation is actually inflation expectations. So there's this psychological thing that ends up happening during an inflationary environment, that a lot of employers, what they do is they raise prices, and then they also increase the wages that they pay their workers. And this is all done based on inflation expectations. So when workers are paid more, this obviously creates more money in the economy. But at the same time, you also get higher prices from those consumer goods. So this really does erode the middle class, especially the lower class. And this really does create a lot of problems in those areas. So what this is called, through like historical perspectives, this is called a wage price spiral. So when you interfere politics into doing the right thing from Fed policy perspective, this is you have the chance of creating a wage price spiral, or even increasing inflation expectations, which I think inflation expectations have been going up for the better part of the past 3, 4, 6 months, somewhere in there, 3 to 6 months, let's say. So when you have Joe Biden coming out and he's talking about how there will be a rate cut this year, this is a huge problem, because this brings us back to the 1970s, of that period of time when politics got interfered with Fed policy. And it wasn't until Paul Volcker came in and said, you know what, we have to do what we have to do, and we're going to do the right thing. And they quote unquote kept at it, as Paul Volcker ended up saying. So when we see those headlines, like, we should almost even be saying to ourselves as Americans, because I assume there's a lot of Americans watching this right now. So a lot of Americans should be thinking to themselves, like, we want to make sure that the inflation genie is put back into the bottle, so that we can have sustained economic growth. And not only that, but it helps our stock returns on a forward basis, because now we don't have to always be talking about inflation, rate hikes, whatever it might end up being. And it actually creates the sustainable environment for stronger and more structural economic growth when you have moderate inflation, around 2%, let's say 1.5 to 2.5%. So just in that zone right there. So like when we think about the expectations here moving forward, Jerome Powell talking this Tuesday, that's basically where this whole rant came from. Sometimes I do that. So Jerome Powell talking on Tuesday, that is really important. We need to know exactly what he's thinking about from a rate cut or a rate hike expectations. We need to know exactly what he's thinking about. Like, how is he thinking about the recent inflation reports? Because there's been about 4 bad reports in a row right now. Like, is this going to adjust the policy looking forward? Is this actually going to put rate hikes on the table at some point this year? And I personally, so my honest to God opinion here is, I don't think that they're going to raise rates. I think that what's more likely to happen is just a higher for longer narrative. I think that 5.25 to 5.5 federal funds is going to be a lot. It could be around for a lot longer. But what on the other side of things, what we could also experience is a steepening in the long end of the yield curve, and that's that bear steepening that I was talking about, which could actually, from a bond market perspective, tighten financial conditions even further, tightening up that lending market. So that I kind of went on a stint there, but we got to make sure that we're talking about things looking forward here. We have a lot of earnings coming out. So not only is inflation really important, right, but we have to make sure that we're paying attention to what a lot of the corporate earnings are that are going to be coming out. This is a really cool new thing done by Savvy Trader. And no, this isn't connected to my portfolio. This is like something Savvy Trader ended up doing. And I think it's actually really, really clean, and it's really neat. So we can see, so like we got United Health Group coming out, and we can actually take a look at a lot of their expectations, the EPS expectations, the revenue expectations. This looks like it's their latest one. And then these are what the expectations are looking forward. So you can actually see that there's expected to be a $99.47 billion revenue for Q1, and an EPS of 673. So you can see that we have not only just United Health Group. I think there's a few people that own that, but there's also going to be TSMC coming out. So the Taiwan Semiconductor. This is important. It's going to be really, really big for NVIDIA and an AMD and a lot of those other major non-fab companies in the semiconductor space. The reason why is that TSMC basically manufactures all their chips. So we're going to be able to get a really good outlook looking forward about how are they seeing the demand in the AI cycle, or in the data center component of their revenue that they're getting, like, because they should provide commentary about AI and AI data center build outs. And then we also have Netflix. A lot of people probably do have Netflix. So Netflix is going to be coming out. People always pay attention to their subscriptions. I have Netflix. Starting to wonder why I even have Netflix, because I think I watch Hulu more often these days, like Paramount Plus. And then what I think is really important. Sorry, my dog is itching himself. Cody, Cody, stop. This is a live. This is a live call, right? So I don't record these. These are actually live. Okay. So then, what I think is actually really important is it's actually going to be looking forward. We have Tesla coming up, not this week, but next week. This one is big for me personally because this is where there's been a lot of noise recently about like what is Elon Musk thinking about from their autonomous driving? Like how is that? You know, like what do the numbers even look like? Like, is there even more adoption going on right now? Are there people actually buying the $99 a month subscription? Like these are things that I'm really wanting to know. And then we're also going to have Chipotle. I know some people own Chipotle. I actually bought a new stock. I'll actually talk about that stock. I don't think that I've even shared this publicly that I even bought the stock yet because I'm still building out the position. So I've been kind of selfish. So I bought a new stock that's actually related to Chipotle and it's called Kava. So I think that, my gosh, man, this is kind of the tough part about like having this camera when the sun's setting because now my camera's all messed up. So it's ticker symbol Kava. I think that this is actually a really good company for a lot of people to. I'm going to throw this one on your radar here, guys. So Kava is, and I got to make sure that my camera looks right. All right, everything looks good. Kava is a Chipotle style restaurant. So what they do is they basically offer a bowl, and it's laid out just like Chipotle. So you can build your bowl, and what you can do is you can have your own kava bowl, and it's a Mediterranean style bowl. And when you look at the reviews, there's a lot of people that are drawing comparisons to Chipotle, and some people who eat at Chipotle frequently really do like this kava brand, these kava bowls. And I actually initiated a new position. It's a very small position right now. I think it's only like 1% of my portfolio. But right now, I think that this is a really good company for people to take a look at because they're expected to continue to grow their restaurant count. I think they're opening 50 new stores this year, up from I think right now they have about 309 stores currently open. They're going to open up another 50 over the course of the year. They expect to own about 1,000 stores by 2032. So what I'm thinking here is that there's probably about a 350% upside over the next 6 to 7 years. That's obviously going to outperform the markets if they can just meet their expectations, their internal expectations. I think this is a really good company. The balance sheet looks really good. They just turned GAAP profitable. I mean, I think they have like $350 million of cash on their balance sheet. Really no debt. It's a really good company for people to take a look at. So I think that a lot of people should. I mean, right now the valuation doesn't look super attractive. So what I've been doing is dollar cost averaging into this company. I like it more underneath 60. I'm not sure if we're going to get there. Possibly in this correction. If we do get back into, so we can actually take a look at the technicals here in this correction here, because I do think that we're actually going into a correction. If we actually get back to Kava's 200-day moving average, this would be in a zone that I'd aggressively start buying this company. So right here, and you can see how I'm kind of looking at this, like this $58 $58 to $60 range. I do think this is a structural support. This is a clear cup and handle where you even have it come up. It's just about to test it, comes back just a couple percent back into its 50-day moving average, resumes its uptrend, and then now you can see that it came back in and it actually retested the previous breakout. So this is a classic multi-bagger stock in the making from like the what is it called? How to Make Money in Stocks by William O'Neill. I read that book, believe it or not. Even though I'm an investor, I read that book, and I do pay attention to these chart formations here. Not only so, like when they're growing revenue, earnings, cash flow, there's a strong market demand for them. I mean, things are very optimistic about this company. Anyway, let's go back to the forward outlook here. So I do think, let me wrap up here. Actually, I'm starting to just kind of ramble. So the total picture, because I see that there's been a lot of new people that have joined over the past, let's say, 30 minutes or so. What I talked about in the beginning is inflation, right? And I talked about how inflation data came out worse than expected, and how this is likely to put pressure on the markets. And you can actually see that, especially when you're taking a look at the technicals. When you have that MACD curling over, I got to pull up my chart here. When you have that MACD curling over, you can see right here on the weekly chart. The weekly chart. So how I think about stock charts is that on a daily chart, that's going to be, there's obviously daily trends, and then there's weekly trends, and there's monthly trends. The best way to think about it is that monthly trends determine weekly trends, and weekly trends determine daily trends. So if you know what all of them are doing at any given point in time, you get a better understanding of what like the longer term, the short term, and then the shortest term are likely to be. And so when I see the weekly MACD curling over, what that tells me is like you can even come back into here in that August time frame in the NASDAQ where the market commenced to selling off at about roughly about 10%. Then you also had another stock market correction over here, even in 2021 when we were spending money like a drunken sailor. And then we also had another period of volatility in early 2020. You guys may know the COVID stock market crash. Not sure if you guys were living underneath the rock. And then you have like in 2018 here too, where you also saw that MACD once again go down and it curled over, and that's what we're seeing here in the NASDAQ. And I do think it's important to pay attention to that we should expect volatility. We're also even seeing that here in the S&P 500. So rehashing that once again, MACD curling over, RSI coming off overbought conditions makes a lot of sense to pull into previous breakout highs. So the previous breakout highs, this is what I'm talking about right here. So the previous highs made in 2021 makes a lot of sense to see that market come back down into this area over the next couple weeks, maybe even the next 2 to 3 weeks, or maybe even the next month or two, whatever it might end up being. So we're seeing a lot of weakness in the economy. The macro data does not look good. The yields are going up, and the valuations are high, especially on the S&P 500. This is a perfect recipe for some weakness in the short term. But I do think that this is going to be a viable opportunity. I do think this is a stock market correction that's going to position investors for a full year's outperformance, especially when it comes down to high beta stocks, because I do think the inflation dragon will be slayed. I'm pretty confident about that. Jerome Powell does seem like, and this is going to be important to pay attention to him on Tuesday, like I mentioned. We have to know what he's thinking about. Is he going to keep his opinion, or is he going to keep his policy out of the current political cycle or the election cycle? This is very important. I think he will, and I think that he'll talk about how he's going to remain independent, and he's going to stay steady in his resolve. That's what I think that he's going to say. I want to see him do that. I think that's going to provide some relief to markets if he does that. Higher for longer isn't going to break anything yet. That's from what I can just see right now from the current economic situation that we have. But we could experience economic weakness. We want to see inflation get reeled back in. Inflationary market cycles are historically difficult. It does take from the 1980s. They didn't even see 2% inflation, I think, until like the back half of the 1980s. Or even in the early 1990s. So when inflation comes out, it takes quite a bit for that to actually get back down to 2%. And then we could even see higher rates for a longer period of time. So making sure that we're just digging our heels in and just saying, whatever ends up happening is whatever ends up happening. But it doesn't mean that the stock market can't go up. And I do think that we're actually going to have an up year, and things are going to be really good at the back half of this year. But after this stock market correction. So I think that's all I got for you guys here today. If you guys have any questions, make sure that you leave like a post down and a comment down below. Let me know what you guys' thoughts are. If there's anything in particular that you guys want me to cover on these weekly live streams. But until next time, as always, my friends, you stay classy.